So if we see inflation, let's just say stay in a range of 3% or stay in a range of 4%, maybe it goes up a bit. That's not going to deliver enough income growth. That's not going to deliver enough inflation to support the housing market. So I think we'll see the housing market grind down. There's also an alternative scenario, which maybe we could discuss later or in another video. What if inflation really rears its head again, goes back to double digits? That would also probably alter my forecast. But I think the baseline forecast is a grind down on the housing market over the next 3 years on a national basis, where prices start to incrementally drop, maybe in the second half of 2025, and then incomes go up, is the baseline national forecast.
Okay. So is it fair, and I don't want to put words in your mouth here, but is it fair to say that you think that the current elevated ratio of home prices to incomes is going to trend down over time? And whether the the average home price goes up or down as a result, will totally depend on how incomes grow. But that ratio of price to income, you think, will eventually start mean reverting, which all extremes should do.
Yeah, I think it will. I feel very confident saying this situation in the housing market won't last, where the typical home value is trading for 4.3 times median income in 2024. We just really haven't seen any historical precedents for this continuing. This data goes back to 1953. There's been three peaks in terms of home prices surging relative to income: 1954, 2006, 2022. Only 3 times have we ever seen prices relative to incomes this high. We didn't even see that in the early 80s when we saw the mortgage rates at 18%. Actually, in the early 80s, it wasn't really a bubble because home prices to income were still at a fair range. Even in the inflation of the 70s, home prices to income didn't go up, meaning incomes kept pace with home prices. So what happened? In 2006, the last bubble, we had a big crash. Prices went down, which is why they got more affordable. In 1954, we could see home prices to income also went way down, starting in the late 50s. Why? Not because prices dropped. Prices actually traded sideways for about a decade, but it was because incomes had their biggest surge in US history.
Mm-hmm.
Nominal incomes in the late 50s into the 60s spiked, which made housing more affordable. So this scenario is historical precedent for, what you described, Adam, of the market trading sideways. 06 is historical precedent for the market crashing to return affordability. Maybe we see something in between, right? Because this housing market has flavors of what we saw in the mid-2000s with what the builders are doing, with all the investor speculation. We don't have as many bad mortgages, so the downturn on nominal prices likely won't be as bad. But we still have other similarities with the mid-50s into 60s, where maybe we're going to see better nominal income growth as well.
Okay. All right, Nick. Well, look, we're coming up on the hour here. I definitely want you to give folks direction on where they can go get the Reventure app and whatnot. So we'll get to that quickly. But as we sort of wrap things up here, what concluding bits of advice would you have for both the aspiring home buyer and the, aspiring home seller who doesn't want to wait so long that they perhaps get in the position where they have to be a motivated seller?